We start today's market talk. In real life, things fluctuate between pretty good and not so hot. But in investors' minds, they go from flawless to hopeless. Today, trading dominates, so everybody is on tenterhooks. Hence, any bad news, negative news gets punished severely. And in addition to the stocks which are in momentum or they are in news, people feel that they will be in trouble if they get out. So, despite the high valuation, people are not able to sell them. Hence, FOMO is also very strong. Key issues which we need to analyze. What to look for beneath Friday's Q2 GDP headline. Now, the real GDP growth of 8.2% was better than all estimates, while the nominal GDP in Q2 fell from 8.8 in Q1. So if you see, it has fallen from 8.8 in Q1 to 8.7. Now what happens is the nominal GDP growth affects the fiscal arithmetic. It will lead to lower tax revenue, could also increase fiscal deficit, fears of which have led to 10-year government bond yields remaining at 6.5. So if you see the 10-year government bond yield has remained at this 6.5 level despite there is so much of talk about interest rate cuts from RBI governor, etc. The reason is because people are afraid that there would be fiscal slippage. Government may be forced to borrow more to do their expenditures because the projected earnings of the government will be lower because of lower GDP growth, nominal GDP growth, and lower tax collections due to GST cut, etc. And that is what the bond yields are reflecting. Business too are more bothered about nominal rather than real GDP growth simply because the nominal growth determines the profits. So if you have seen, the nominal GDP growths have been trending lower in India. Now GDP deflator was 0.46 uh, in this quarter versus 0.9% in Q1. GDP deflator is supposed to reflect the overall inflation in the economy. Now, there was also a base effect that boosted growth. So, if you see Q2 FY25 due to elections last year was subdued. Subsequent 2 quarters were strong. So, now that base effect will not be there. So, that is another factor. Uh, Base effect will not be able to boost that kind of a growth. Uh, and this quarter, if you see, the real buoyancy came in the services sector. So, what is the future? GST cut should boost consumption, but the base effect of GDP growth will turn unfavorable from Q3 onwards. Though there was a lot of pre-selling because of tariffs by the exporters to the US, but a US trade deal with lower tariffs should lead to higher exports and will support growth. So the immediate question is, will RBI look at solid real headline growth rate and robust consumption growth and decide not to cut rates and keep the powder dry, or look beneath the hood and decide that things are not as rosy as they appear to be? So let's see what happens. Now the other question is the Nifty rally mm, built on sand? That means because Nifty and Nifty Bank are at all-time high, the broader markets are showing weakness. 60% of the gains from October lows this year have come from just six companies: Reliance, HDFC Bank, Bharti, SBI, L&T, and Axis Bank. Next year comprising Infi, Shriram Finance, HCL Tech, TCS, Mahindra and Mahindra, ICICI Bank, and Asian Paints have contributed to 27% of the gains, leaving the remaining hundreds of stocks with minimal movement. Small cap index trades below 20 week EMA, exponential moving average. It signals market weakness. As 2025 ends, most mutual funds and PMSs returns remain flat. So, unless a broad based rally occurs, this time correction, which we are seeing right now in the broader markets, will evolve into a price correction, which the strong performance of few stocks has postponed till date. Now, will rate cuts revive market sentiment? When there is ample supply of money at lower interest rates, markets witness euphoria. And if India also cut rates and Bank of Japan hikes rates, then the cash carry trade unravels and triggers outflow of money. Now, in the next 10 days, there are going to be rate decisions by three major banks, that is RBI, Bank of Japan, and Fed. So it is going to be interesting time next 10 days how each one of these banks, central banks, think about the rates. These things can bring stock markets lower. That is the if the cash yen cash carry trade unravels. Rate cuts will make depositors unhappy because they will get lesser interest on the money they are putting in the banks. And banks, if you know, are already struggling with lower deposits. Credit to deposit ratio has already hit 80% overall. So if the risk is lower deposits, we may see a cash crunch in banking system. They will not have adequate amount of money to lend. Now coming to FIDI data. So if you see here, FIs have net around 87,596 short positions in index futures. On Friday, they sold call options and they bought put options. So they are strongly bearish. Pros, to see, they are medium term indecisive or medium term bearish in terms of index futures position, but they have sold calls and very small amount of put buying they have done. So they remain mildly bearish in terms of index options. Clients, they are fully bullish in index futures, bought calls and sold puts in index options, and they remain strongly bullish. Now coming to FIDI data. So if you see, the FI short position in index futures increased from 1.25 lakh short positions on 3rd November to 1.62 lakh, and then on expiry it decreased to around 94, and now it is remaining at the same level. But on the days on which FIs turn bullish in terms of index options and index futures, those are the big moving days on the market. So if you see, on 12th November, index moved 0.7% because of the bullish trades. Then on 19th November, it moved 0.55% again due to the bullish trades. And on 26th November, it moved 1.24% again because they were net bullish both in terms of options and in terms of index futures. Now, coming to the US markets closed higher this week as sentiment was up due to optimism for a December Fed rate cut and continued enthusiasm in AI sector. Delayed economic data showed that economy is cooling enough to justify a rate cut without collapsing. So if you see here, the yields have come down to around 4 now and expected to head lower in case after the dot plot for 2026 is also revealed in the next Fed meeting. And similarly, the dollar index also came down, was down around a 0.7%. Gold climbed up, was up 2% on expectations of a rate cut. Uh, Silver moved higher. It is much more volatile. It has higher beta, so it was up nearly 6.6%, and it is just below 54 level. And once it breaks through this, it may head to 58. Copper was also up around 3% on the expectations of rate cut. Bitcoin bounced from the lows it had made to around $80,000 dollars to a Bitcoin. From there, it bounced up to 90,000 level, so remains volatile. Brent crude, no significant movement because it has corrected a lot. It has come to around 62 levels because of impending truce between Russia and Ukraine. S&P 500 was up 3%, 3.7%. Nasdaq was up 4.9%, and Dow also was up 3.18%. So basically, they're all showing enthusiasm because of expectation of a rate cut in the next meeting. So right now, the future markets are pricing in 87% chances of rate cut at this meeting. November non-farm payroll is due early next month, around 5th December, which will be the final data print before Fed's policy action on 9th and 10th December. So around 10th December, the decision will be out, and markets are already pricing that in. Now coming to India, India VIX has declined after the volatile action last month. Uh, so now it is coming down after the volatile action in November. And Nifty, if you see here, Nifty's had 3 consecutive weeks of green candle, has reached, tested its all-time high, made a fresh high, ended at a new weekly closing high, and is, you see here on the daily charts, it is continuing with higher high, higher low pattern. India VIX, as I've shown you, has declined. So support is around, first support is around 26,000 and the second support is around 25,936 level. That is a 20 EMA. Target should be 26,500 initially, and then we will see from there. Uh, Moving averages are trending upwards, so that is positive. So if you see here, Nifty is an uptrend and continues to scale new highs. Uh, though overall market environment, as I'll show you later, remains narrow due to lack of widespread strength and breadth. Now it may attempt a breakout above this long-term resistance level. So this is a zone for decision making. Any upside sustainability above 26,300 level will be crucial. So even if you get a big gap up on Monday, it has to sustain above 26,300 for a sustained uptrend. Now Nifty next 50 is not showing any strength. It is just at around 20 EMA. So it is just taking support there. It is around 10% lower from its previous all-time high. Nifty Bank has broken through the uh, rising trend line. So it is again in an uptrend and leading the market. Fourth week of uptrend. Uh, on the daily chart, it made a kind of a doji, but I think 60,000 is a given. So once 60,000 is taken out, then it should head higher. And rally can extend to 60,200, 60,500 from here. So market is poised for further gains, and sentiment is supported by Q2 GDP print. Now, PSU banks has been leading the Nifty Bank rally and continues to head upwards because of positive expectations from the budget, some kind of a merger and more FDI coming in the PSU banks, etc. IT again has broken through the 200-day moving averages, and so now it is poised for a kind of a breakout. Nifty metals uh, rose around 1.5% last week based on weakness in the US dollar and expectations of rate cut. So it should head higher. Autos, because of good GDP print, should head higher. So it has tested the previous all-time high, then retraced a bit, but now it is showing momentum, should head higher. Defense was subdued, didn't perform much. Midcap Select is breaking out. It has made a fresh high. So it should continue its upward journey. While small caps have been consolidating, it was down 0.1%. Uh, Maybe the moving out of small caps may be taking place due to shift to gold oblique silver right now because they are in momentum. So it seems that the liquidity is moving to them. Prominent stocks, if you see, HDFC Bank is close to its previous all-time high, bounce from the 20 EMA. Uh, Once it breaks this 1020 level, it should head higher. Reliance has broken the intermediate target and has is now heading to 1600. So above 1600, it should head higher. Larsen has broken through the previous all-time high, and now it is making fresh all-time highs. So every dip to this uh, 3950 odd level is a buying opportunity. Now I'll cover two stocks today. First is Kaynes Technology. It's a leading integrated electronics player in India with backward integration into PCB and vertical integration in OSAT. So what they are doing is they are basically in electronic manufacturing service. So they are doing backward integration to PCB and forward integration into OSAT. So they are trying to get involved in larger electronic supply chain spanning across wafers to end user products. So from making semiconductors, uh, then to electronic manufacturing, and then to printed circuit boards. So they are trying to get into the complete supply chain. They are redefining their position in the ESDM ecosystem, electronic system design and manufacturing. Uh, and they're wanting to become a fully integrated electronics original design manufacturer because companies like Dixon are not original electronic manufacturer, but not designing. So the margins are lower. So they are trying to become design manufacturers so that the margins are better. Now, uh, the stock has been correcting for the last few days. So we'll go through the reasons for them. Firstly, if you see here, for Q2 FY26, they had 58% revenue growth, margins improved, and net profit was up nearly doubled. So, but the stock is correcting. And there are reasons for that. We will go through that. The reason is that the revenue growth of the core EMS business, excluding Iskra Meko, which is the smart meter business, has been only 20% in FY25 and only 5% in H1 FY26. So the core EMS business is not doing well. Management has attributed this to slowdown in most EMS verticals, with Scrum Echo already in the base in H2. So there is a possibility that the revenue growth may moderate in H2 FY26. So if you see here, the revenue growth of the company is now more because of subsidiaries like Scrum Echo than the core EMS business. And the core EMS business is stagnating. It just grew around 7.9%, while the subsidiaries have grown around 2x, 215%. Gross profits also are mostly because of subsidiaries than the core business. And if you see here, uh, the subsidiaries started performing in Q3 FY25. So the base effect will come into play from the next quarters for subsidiaries also in terms of overall profits and revenue growth. Margins also have declined and they are overall higher because of subsidiaries. And EBITDA has is now higher for subsidiaries and it has nearly become 8x for subsidiaries as and it has declined for the core business. Similarly, with EBITDA margins also, they have declined for the EMS business, but subsidiaries, the EBITDA margins has gone up and profit after tax also now from Q2 FY25 subsidiaries was at loss and it is now giving same amount of profit as the standalone EMS business, while the profit of the standalone business has remained static. So now the subsidiaries are contributing 50% of the uh, profit. Now, the other problem is that the smart metering business entails high working capital. Genus operates at 275 plus days, and thus the stocks trade at relatively low valuation multiple. Genus and HPL trade at 21 and 28 times trailing 12 months P. So should Kaynes smart metering business be given elevated multiples as its core EMS business right now? So as I have shown you that right now the major earnings are coming from the subsidiaries, not from the EMS businesses. So why should the Kaynes overall should trade at higher multiples? Now, debtors rose from 570 crore at end of FY25 to 1120 crore at end of H1 FY26. So if you see their balance sheet as on H1 FY26 consolidated, so if you see here the in previous year on year, the trade receivables have nearly doubled to 1122 crore from 530 crore. It has created a provision for doubtful debt of 55 crore in H1, 10% of outstanding debtors at end of FY25. And these debtors do not include deferred receivables of Iskrameco, 230 crore now versus 300 crore originally, which the company is looking to discount. Now, discounting a receivables means obtaining a short-term loan by using account receivables, unpaid customer invoices as collateral. It helps in getting working capital and cash flows, but the advance rate is 75 to 85%. So the company has to take a cut because the lender is taking a risk. So if you see here, it has in this quarter from their cash flow consolidated statement of cash flows, they have taken a provision for doubtful debts of 55 crore. So this is one more factor that the receivables may be in doubt. That's why they are taking a provisions here. It has infused only 150 crore to 380 crore equity in bare PCB multiplayer and OSAT, which they are trying to create and has not yet received government subsidy. This looks low in respect of project cost of 1400 crore to 3400 crore respectively. It is looking to invest 1700 crore in Flex, HDI, PCB, etc. businesses, 1700 crore in copper clad laminates. Copper clad laminates is a foundational and critical material used in fabrication of PCBs. And rupees 300 crore in camera modules for the next few years, funded through mix of equity, debt, government subsidies, and internal accruals. It may need to raise funds again, and this is what the market is afraid of, that it may not be able to get adequate funds for all this growth and all the projection. So they may be required to do a QIP. That means equity dilution, take more debt, so that will increase the interest costs, etc. So if you see here, the receivable days have increased, the working capital days have also increased. So the cost of money for them has gone up, and receivables have risen sharply in the last 6 to 9 months. Now the receivables, current debtors, long-term is ISMRA MECO debtors as a percentage of total revenue are around 42-43%. So that has increased. So the receivable days have increased for them. Now they are trying to do a lot of new projects for OSAT, bare PCB Tuticorin, copper clad laminate, camera modules, etc. Now, some of these investments were approved under various schemes. SPECS scheme, that is Scheme for Promotion and Manufacturing of Electronic Component and Semiconductors, where they're supposed to get 25% capital incentive per central government. But now with this scheme has been subsumed into ECMS scheme, Electronic Component Manufacturing Scheme. So details of incentive to be received by Kaynes are unclear right now. So now all these issues are there under various schemes for them, where they are waiting for clarity on getting the government uh, government funding for these projects. So there is a cash flow problem for them. And because of these issues, the balance sheet is in a problem. So Keynes technology, if you see financials in this year 26, they're expected to do around 4,000 crore revenue and around 69 rupees EPS and 6,900 odd revenue in FY27 and 9,100 crore in FY28. So they should do around 87 uh, rupees EPS in FY27. So taking a mean of around 80 for both years, 1 year forward earnings right now, they are at around 70 times. In the present, you see their present chart, they are at around 70 times, and it has come down from 7,600 level. So if you see their chart, it has already corrected 2,000 rupees. So it was, say, take it at 80 rupees. It was trading at 90 plus times. Now, if there is so much of problems are going to be there, so it has totally got sold off in very quickly over the last 7 8 weeks, and it has come down to 5,500 level. Now, last time it corrected, it came down to 4,000 level. So I think now once it has broken the 100 EMA, so now next support should come at around 4,900 level for uh, this stock. So that is the worry. Next I will cover is Paytm. It's called 197 Communications Paytm. The core business is to acquire consumers and merchants through payments and distribute financial services to them. So they have roughly 7.5 crore monthly transacting users, 4.7 crore merchants, who they try to use to do distribution of financial services, which are a higher margin business through loan distribution, stock broking, mutual fund distribution, insurance broking, etc. It's a full stack merchant payment leader serving MSMEs and enterprise payment merchants. So they provide services, software, hardware, etc. to various merchants with various payment instruments across enterprise merchants and MSMEs. So basically, they have three businesses: payment services, payment to consumers, they charge convenience fees; payment to merchants, they charge subscription revenue; merchant discount rate MDR on credit cards, debit cards, etc. Platform fees for payment gateway. So this is their payment services, how they earn. Then financial services, they do lending, so they charge sourcing fee, commission for loans, collection fees. Then wealth management through Paytm Money, they charge broking, commission fees for mutual funds, etc. And for insurance, again, they charge commission for selling these products. For commerce and cloud services, for commerce and ticketing, they charge commission, and for marketing and cloud advertising for merchants on Paytm app. So this is their basically revenue source. Now, the reason why the stock is moving up is because there is significant earning growth potential stemming from likely growth in payments and loan distribution, margin expansion prospects from a combination of product upgrades, improving UPI mix towards chargeable products, saving initiatives, and operating leverage, and presence of optionality through possible offerings, complemented by its diverse presence across payments ecosystem. Operating metrics remain stable. Greater focus is on monetization. Strong revenue trajectory sustains through payments and financial services, better margins in payments to aid earnings. Last quarter, it also received its payment aggregator license approval, which has allowed it to onboard new online merchants who have higher merchant discount rate. Total devices deployed as of Q2 FY26 stood at all-time high of 1.37 crore. AI Soundbox transforming the Paytm Soundbox from a payment alert device into a intelligent business assistant which delivers real-time insights on payments and business performance to merchants. Financial services revenue robust while merchant credit is the bedrock. Levers exist to drive additional growth in years ahead. The new postpaid offering is a spend now, pay next month UPI overdraft for Paytm customers offered across merchants both online and offline. Contribution margin strong at 58.5% in Q2 FY26 remains healthy. So if you see there, this quarter performance from operational KPIs, it's very healthy. Registered merchants increased 12%, subscription merchants increased 22%, gross merchandise value increased 27%, total transactions were up 50%, and monthly transaction users were up 6%. So strong performance. In terms of revenue, the payment services revenue went up 21%. Financial services distribution revenue went up 63%. Marketing services revenue declined 25%. The total revenue from operations was up 24% to 2000 plus crore. So their contribution profit is now positive, was up 35% to 1200 crore. So the contribution margin is now 59%. So if you have seen contribution profit margin is 59%, considering all these things, now it is EBITDA positive. So EBITDA was up 97% Q on Q, while September 24 it was EBITDA negative, and EBITDA margin is now 7%. So very positive earnings. The gross in terms of payment services, gross merchandise volume increased 27%. Subscription revenue is from charges merchant pays for various monthly services, including devices. So the merchant subscription, including devices, is up 25 lakh year on year. Net payment revenue was up 28% year on year. So distribution of financial services, low penetration offers significant long-term opportunity. Revenue from distribution of financial services is up 63%, but it has got long growth of potential. Key financial service customers is up from 6 lakhs last year to 6.5 lakh. It relaunched the Paytm postpaid, a spend now paid next month UPI overdraft offering up to 30 days credit from bank partners. Marketing services revenue declined, but is this can drive additional monetization from merchants. So if you see their earnings, the GMV was up 25%. Revenue from payment services was up 21%. Revenue from financial services is now up nearly 50%, and the loan take rate is up to around 7.5%. Total cloud and commerce revenue declined around 21%, but it is expected to improve from here. So total operating revenue was up 20%. It is going to grow steady rate from here. Contribution margin is going to remain at this 58% range. So it is net EBITDA positive now. So it did around 550 crore of EBITDA. It is expected to do 550 crore of EBITDA in FY26 with a margin of around 6.6%. And this EBITDA margin is expected to improve from here with a PAT of roughly 1500 crore in 26 crore in FY27. So it is going to be a profitable from here. So if you see the net sales, it will expected to do around 8,300 crore of net sales in this year and 10,450 or 65 crore in FY27. Now the market cap is around 84,000 crore. So mostly the businesses operate in India. All these consumer tech businesses operate at 8 to 10 times price to sales. So right now it is with 84,000 crore market cap, it is at around for FY26 sales, it is at around 10 times price to sale. For FY27, it is at around 8 times price to sale. So it is kind of fully priced, and 1 year forward, it can go up around 15-20% from here. EBITDA margins are improving. It is becoming profitable. So it is expected to do around 1,500 crore of net income in FY27 and around 2,200 crore in FY28. So GMV is going to grow around 25%. Total revenue from operations around similar. Contribution margin is steady. So it is the book value is around 256. So for FY27 time, that is for FY27, the book value is expected to be 256. So it is at around 5 times FY27 book, which is reasonable right now. So coming to that chart, it has risen from the lower levels of around 400, and now it is on an uptrend, riding the 20 EMA. So every dip is a buying opportunity, uh, closer to 1250 on. So it's a buying opportunity. So you have to ride this stock for a target of around 1400, 1500 in another year or so. So I have finished. We will take questions now.